Welcome. Thank you for joining me as we break down one of the most fundamental concepts in financial analysis, discounted cash flow, or DCF. My goal in this video is to give you a crystal clear, approachable explanation of what DCF is, how it works, and why it matters, whether you're a finance student, business professional, or just curious about valuation. By the end, you'll understand the core ideas and be ready to apply DCF thinking in your own work. Let's get started. Here's our roadmap for today's session. First, I'll introduce DCF and set the context. Then, we'll move through its key principles before walking step by step through the DCF calculation process. We'll explore the major inputs and assumptions you need to watch out for, discuss DCF strengths and its limitations, examine real-world applications, and wrap up with some final thoughts. Ready to dive in? Let's begin with the basics. Discounted cash flow is at the heart of how businesses and investors think about value. Instead of looking at only today's numbers, DCF is all about projecting future cash flows a business or investment will generate, and then translating those future values back into today's dollars. This allows leaders and investors to make decisions based on long-term profitability and risk, rather than just a snapshot in time. DCF is a core tool across finance, from budgeting and mergers to equity analysis and large-scale investments. Its scientific, time-tested approach gives clarity and adaptability in a world full of financial uncertainty. Now, before we get into the mechanics, let's establish some of the key principles that make DCF so effective. At the heart of DCF are three powerful principles: forecasting, risk adjustment, and time value. First, with forecasting, the idea is to make thoughtful, grounded predictions about how much cash a business or investment will bring in down the line. Next, risk adjustment tells us that money in the future is not as valuable as money today, thanks to things like inflation, uncertainty, and opportunity cost. So, we discount those future cash flows to make fair comparisons. Finally, the time value principle means we use a discount rate that reflects both the risk and the timing of these cash flows, letting us compare investments even if their risks or timelines are wildly different. Understanding these principles sets us up for the next step, seeing how these pieces fit together in practice. To build a credible DCF model, you'll need to put together three essential parts: outputs, the discount rate, and sound forecasting. The output side is all about solid, tangible metrics, like net present value, NPV, and internal rate of return, IRR. These numbers help decision-makers compare options in a standardized, apples-to-apples way. Next comes the discount rate, which is a critical piece that reflects the cost of capital and the specific risks of your case, often calculated as the weighted average cost of capital, or WACC. And of course, none of this works without clear, careful forecasting. By making realistic projections and stress testing them with different scenarios, you can make your DCF analysis much more credible. So, how do we put it all into action? Let's break down the step-by-step process. Let's walk through the 4 stages of a typical DCF calculation. First, projection. This means estimating how much cash the business or investment will generate each year, based on realistic assumptions. Next is discounting. Here, you apply the discount rate, such as the WACC, effectively shrinking those future cash flows to reflect their present value. Third, terminal value is calculated to capture the value beyond the forecast period, often representing a big piece of the final number. And lastly, summation. You add up all these present values, both from your yearly forecasts and your terminal value, to get the overall intrinsic value. This step-by-step approach creates a logical, defensible analysis you can trust. But to get it right, you'll need reliable inputs. Let's see what they are. Successful DCF models depend on 3 critical factors. First, you need rock-solid cash flow estimates, realistic, detailed projections that include operating cash, investments, and taxes for each year. Second is the discount rate selection, which should carefully reflect company-specific or industry risks. The right rate makes a dramatic difference in the result, so don't overlook it. Third, forecasting is especially crucial for the terminal value, the tail of your projections, often relying on standard methods or industry benchmarks to estimate long-term growth. Together, these inputs build a strong foundation. Now, let's weigh the method's strengths and weaknesses through a quick SWOT analysis. Let's take a balanced look at where DCF excels and where it can stumble. The strengths. DCF is systematic and transparent, making it flexible and suitable for a wide variety of business types and sizes. Weaknesses. The results can be sensitive to even small changes in your assumptions, making the output volatile at times. And figuring out a reasonable terminal growth rate can be a persistent challenge. On the opportunity side, DCF is incredibly versatile and can adapt to all kinds of assets and industries. Plus, new data sources are helping improve forecasting accuracy. But be mindful of threats. Poor forecasting can lead to misleading results, and if your model is too complex, it can be hard to maintain and easy to get wrong. Let's see how these strengths and limitations play out when you apply DCF in real scenarios. The best way to keep your DCF model reliable is through frequent validation. This means reviewing data carefully, running scenarios, and continually updating your inputs to reflect changes in business or market conditions. One big limitation to watch is terminal value. It can sometimes dominate your results if assumptions are off. Simplifying this calculation or benchmarking against peers helps maintain balance. Sensitivity is key too. If a small tweak in your inputs causes your valuation to swing wildly, make sure your model is transparent and easy to explain so you can build trust with your stakeholders. Altogether, the robustness of your DCF process comes from being precise with projections, validating assumptions regularly, and keeping your approach as clear and adaptable as possible. But when is DCF most effective? Let's see what matters for real-world deployment. For DCF to deliver valuable insights, it's vital to validate your assumptions and have a deep understanding of your sector, business, and the market. Think about it in 3 ways. Does your sector suffer from high volatility? And do your discount rates actually reflect those risks? Can you justify your forecasts? Are management's projections realistic? And have you cross-checked them against market factors? And finally, is the business model proven? Are your assumptions about future cash flows backed by history and market trends? Keeping these questions in mind will help make your DCF analysis truly actionable and reliable. Understanding the core performance metrics of a discounted cash flow or DCF analysis is essential for building trust in valuation results, whether you're an investor or part of a company's management team. First up, net present value or NPV. This metric represents the total value of forecasted cash flows, both the projected and terminal ones, discounted back to today's value. In simpler terms, NPV tells us what those future earnings are worth in today's dollars. A positive NPV means the investment is expected to create value. A negative NPV? That's a red flag. It may not be worth pursuing. By quantifying the sum value of discounted cash flows, NPV gives investors a clear snapshot of whether an opportunity adds or destroys value. Next, we have the internal rate of return or IRR. IRR measures an investment's profitability by identifying the discount rate that makes NPV equal to 0. Essentially, it tells you the project's expected rate of return. If the IRR is higher than your required rate of return or risk tolerance, it signals a potentially attractive investment. But if it falls short, the project may carry more risk than reward. IRR helps decision-makers weigh whether the expected payoff justifies the level of risk involved. Finally, there's terminal value or TV, a crucial yet often misunderstood piece of the DCF puzzle. Terminal value estimates the worth of all future cash flows beyond the forecast period. It often makes up the majority of a DCF's total valuation, so accuracy here is critical. To keep your analysis credible, always compare the terminal growth rate with market benchmarks and realistic long-term expectations. An inflated terminal value can easily distort the entire model, leading to unreliable results. When done right, terminal value bridges the gap between short-term forecasts and the company's long-term potential. Mastering these 3 metrics is essential for producing trustworthy and meaningful valuation results. In summary, discounted cash flow is a powerful financial tool. Its value comes from the rigor of its process and the precision of its inputs. When used carefully, with regular validation and thoughtful assumptions, DCF empowers decision-makers to make informed, strategic choices in everything from ordinary budgeting to major investment decisions. Thank you so much for watching this breakdown of DCF. If you found this useful, please hit like, subscribe, and drop any questions you have in the comments below.